Annika, you've written an article on gilt yields. It sounds like you think markets have got pricing wrong. Could you give me a bit of an insight on how you've got to that conclusion?
Yes, I think it is important that we explain our forecasting methods to you first, which is the JLT Market Forecast Group is responsible for forecasting long-term rates, including long-term returns of several major asset classes. So the 20-year yield is a very important proxy of long-term interest rates to us. And we see how this 20-year yield progresses through 3, 5, 10, and 20 years. What we are saying here is markets are not pricing in this ultra long-term rates, the 20-year in 20 years' time. We also don't believe that the shape of the current yield curve is going to get realized.
Could you tell us a bit more about what you mean by priced in and what shape that you think the yield curve is?
Yes, so the current yield curve is humped at the 20-25-year maturity bucket. To illustrate that, let's say you have two bonds, one a 40-year maturity bond, which yields, say, about 1.7%, and another, which is a 20-year maturity bond, which yields 2% because of the very nature of this humped yield curve. What you would derive from that is that the 20-year yield from 20 years' time is going to be about 1.4%, which is much lower than the initial 20 years return. Now, in a growing economy with stable inflation, an investor will demand higher return for holding a longer term asset, which is clearly not happening now. And this is a function of investor demand in the longer end rather than what market is pricing in as yield. And as you clearly know, this is purely demand from insurance companies and pension funds. To look at it another way, if you consider this hump of this yield curve is going to remain constant, which is not the same as forward curves being realized, you would see that investors are going to lose money as they progress through time in the medium term.
A large part of your research was macroeconomic factors. Are you saying that these will lead to higher interest rates in the future?
Well, there is no economic rationale that mean reversion is going to happen. But trends always gives us some very important insights. So, for example, when we studied bank base rates, the real bank base rates over the past 300 years, we saw, barring world wars, there has been rarely any instance when 5-year moving averages have been below zero, which is currently the case. So assuming inflation of 2%, nominal yields will be much higher if base rates were to, if these real rates were to mean revert, and will be much higher than what is priced in today in the market. On the technology side, we believe that technological evolution is going to raise the productivity curve much quicker, and that is going to allow companies to generate greater output per unit of labor, which will have a positive implication on GDP and hence real rates. On demography, it's even more interesting. So we have seen, as global population had been, the population boom had been happening over the last 3 decades, savings and investments both were going up, with savings rising quicker than investments, which resulted in, as you know, yields falling over the last 3 decades. But with aging population, this trend is likely to reverse, which means that savings will fall and so will investments, but potentially savings falling quicker than investments. And that will put upward pressure on real yields. And with the inflation component to it, dependents are always inflationary because they are net consumers. So as the working cohort moves from the workforce to retirement, they become the dependents, and hence inflation is likely to go up. So combine the two, the nominal yields would, in the long run, have greater chances of going up. Having said all of this, I mean, these are really long-term trends. Does that mean that there would not be any short-term shocks or short-term volatilities in the market? We are not saying that. We are saying that what is priced in at the really longer end of the curve is most likely not going to get realized, and it's going to rise higher than what is currently priced in.
So are you saying that investors should sell out of gilts and hedging instruments?
It depends. So there are merits in active yield curve positioning, and pension funds might gain from from that without compromising their hedging objectives. But that is a function of their risk budget, that is a function of what their covenant strengths are, what the maturity profile of the liabilities are, etc. For insurance companies, for example, they will have to set aside capital if they have to move away from their preferred habitat. So if the capital adjusted return is higher as a result of doing this exercise, then it would be materially beneficial to them. So I believe that it depends from individual cases. If return seeking assets is a requirement from fixed income, then multi-asset credit is an alternative option.